Hey, what's up, Money Masters? It's Wade Reed here for another episode of the Wealth Acceleration Podcast. So glad you're here with me today. We've begun a series of podcasts on the topic of what we call the family bank strategy. And as promised, I brought in one of my colleagues from Paradigm Life. His name is Gary Pinkerton. Gary, hello.
Hey, Wade, it's good to be here. Thanks. I didn't know you had already set it up ahead of time. That's cool.
Heck yeah. I let my listeners know on my
Manifesting.
last episode that I would be having some colleagues on and doing some interviews. So I like to fulfill on my
Cool.
promises. Yeah. So guys, let me introduce Gary briefly, and then he can take over and tell you more of his story. But Gary and I have worked together for 5 years. We've actually known each other longer than that, though. We had a mutual client that I don't know if he remembers this, but
hmm
I remember seeing his name on a life insurance policy that the client I had that I was coaching, and I'm like, oh, Paradigm Life, Gary. And then we met shortly after that at some event, probably Truth Concepts,
hmm
and started to develop a little bit of a relationship. And when I transferred from my work with Wealth Factory over to my private practice in coaching, and then joined Paradigm Life as a life insurance agent, Gary and I started to develop even better relationship, and we've done a lot of work together over the past 5 years. And so I've gotten to know Gary's backstory a little bit. It comes from the military space, 20 plus years in that, and I'll let him tell you more about that. But what I found really interesting is he was in the typical financial planning model for the first 20 years of his preparations for his future, and then went through some severe financial crisis stuff, and then found what we call the family bank strategy and applied that the past decade plus, and has some really interesting insights to how it works practically, and transition of career as well, from his military days to more of an entrepreneurial uh, business ventures now. So Gary, why don't you tell us a little bit more of the details on that backstory and where you're coming
Yeah,
from?
I won't speak for everybody out there, but I have met many people who are like me in that every experience they've had, every galvanizing experience, really big negative experience typically. I mean, the positive ones make an impression too, but the negative ones, somebody said that a negative emotion is 3 times more powerful, or 10
Mm,
times more powerful, or something like that.
yeah.
Um, so mine, much of my stuff was galvanized actually as a kid. So I'm 55. I grew up in the Midwest in the late 70s, early 80s. Jimmy Carter was president during a lot of my formative years. And then Ronald Reagan came in. And it felt a whole lot like it does today, having made this shift a couple of days ago to the Trump administration, and everybody's super optimistic. Everybody's making investment. It was very similar to that. And the years that preceded that were very, there was an oil embargo going on. There was hostage crisis. Our president, Jimmy Carter, who was a graduate of my great institution, the Naval Academy. I knew him personally.
Mm,
Rest in peace there. And, he was
yeah.
a good person. Maybe not the best, most motivating leader. And when I remember him coming on and doing a national broadcast about wearing sweaters to cut down on energy costs kind of stuff. And so it was just this very much a scarcity mindset that I remember
Yeah.
as a kid. And then interest rates started, rising pretty heavily, early 80s. And we had this large dairy farm. And I didn't understand any of these financial lessons back then. So as this kind of, young brain, not yet developed guy, I'm in high school hating the fact that all my friends get to go play sports and I'm, baling hay from sunup to sundown kind of stuff. And what really irked me, though, Wade, was when my dad would hire them to help us bring the hay bales in, and they would get paid, and I wouldn't get paid.
Oh
Like that was
gosh.
like I knew Dad didn't have the money, but it also was
Yeah.
really kind of frustrating.
Yeah.
And so he'd show up to school in an old car or whatever, and I was driven to make money and have a different future.
Hmm.
And so I just wanted, I'm running businesses to put food on the table. My father's health is failing. It was just a rough area. And thankfully they had always instilled in us to study really hard, right? And so you have the whole jingle from Robert Kiyosaki of work hard, get good grades so you can get a safe, secure job. And that is absolutely what I wanted.
Uh-huh.
And so I got a free ride to the Naval Academy and I went there. And then I've always really been into, I want to be a rocket scientist. I want to be Elon Musk, I guess, back then. And so the highest tech thing we had was nuclear submarines. I got the opportunity to join that, probably like the last dude who got in.
Hmm.
But worked my tail off in nuclear submarines. I commanded one from 2008 or 9 to 2011. And so my first financial experiences there as a kid was just simply, I wanted to have more money, more material things, and be able to raise a family that I didn't have to, I didn't want to feel like I saw my parents feeling when they couldn't give us things that they wanted to give us that broke their heart. And I didn't want anything to do with that. So if I was going to raise a family, they were going to get what they wanted. Right. And so now as an adult, I just cringe even hearing myself say these things. So, but that's where I was focused. And so I start the Naval Academy, negative $2,000 net worth. I had to take out a loan just to, buy uniforms or whatever it was to get accepted. And then, fast forward to now having commanded a submarine and had been a highly paid member of the military with bonuses and things as an engineer, very tough but rewarding career path. Yeah. All of a sudden throughout the 90s, when we had this massive run up, in the markets, and I was doing what everybody else as a W-2 employee was doing at the time, which is just hand your money to the professionals and they take care of it and you pay attention to your job. All that stuff seemed to be working great. What wasn't working great was my interaction with my two young boys, reflecting back on experiences with my own father, realizing now that I'm mature that what really matters is what you leave inside your family as a legacy, not the financial wealth you leave to them. So my wife was worn out with all this moving around and not being able to run her own career. The kids didn't know me. And so I really wanted to command that submarine. And so I knew that as soon as I was done with that, I could retire. And so I said, man, I have turned negative $2,000 net worth into almost $1 million in a 20-year career. Now I can, retire, spend time around my boys and finally let my wife get her career going and everything will be great. So I go off and I pay attention. Again, this is kind of a bad news bears story on this submarine. Like we just had a lot of problems, turned it around. It was an amazing thing. Top submarine in the Pacific at the time when we were done. But I spent all my time on there trying not to get fired. No kidding, like 2.5 years.
Oh boy.
And so when it was over, this, timing's everything. The Great Recession was the entire time that I had my submarine. I didn't even know it was happening. I had no idea. I had not looked at my finances one time.
Pause with me for a second,
years.
Gary. So hold on.
Yeah.
You're like 20 years in. You're, I imagine, close to 40. Yes, 40. Yeah. 45, somewhere in that range.
Yep.
Okay, so you've got a lot of life ahead of you, but in the military, you have an opportunity to retire. Is it 20 years in or 25 years in?
20. You can do it at 20. I actually did 26, but you can do 20.
Okay, so you're thinking about, man, I can get out of this career that I've been in that's been rewarding but challenging once I get done with this commander role on this submarine. And so you've got almost $1 million built up. So you're imagining that's going to be the nest egg that you're using as part of your retirement plan. Is that what I'm hearing?
Yeah, and if you look at like a pension, if you do, yep.
Okay.
If you do a pension, a calculation on what sum of money would you have to have built up to be able to have this military pension pay you for the rest of your life if you're starting at like age 40? I mean, you're an annuity guy. So like when you do those calculations for the clients, like those are big numbers. It was probably like $2.5 million value of the pension that I would have gotten even just at 20 years service. Oh, wow. Much bigger if you go to 30. But so I was like, well, I have $1 million and I have the equivalent of $2.5 million annuity here called my pension. Like we'll be fine. Yeah. And we would have been had that actually played out.
Okay. There's more to this. Okay.
Yeah.
Is this where the negative?
The Great Recession happens.
Okay.
What's this?
I would say, is this where the negative part comes in? The Great Recession?
Yeah. So again, my mindset was I pay attention to the job. Somebody else pays attention to the finances.
Yeah.
And again, looking back on that with what I know today, holy moly, like that is silly. There's not any part of those, however many pillars you want to have. A lot of people say like there's 6 pillars or 8 pillars of your life, right? Like there's spiritual, there's family, there's, religion. If it's actually more than just spiritual, there's financial, there's fitness, health.
Yeah.
And none of those things can you outsource to somebody else, right? Like I can't say, hey, wait, I'm interested in paying you $200 a month so that my wife is always happy with me. Like that's stupid, right?
It is.
You go work out and it'll help my health. Like,
right.
But we've been sold this bill of goods that if you hand your money to somebody else, they will make sure that you have the financial future you want. Well, guess what? That doesn't work. It doesn't, it sounds stupid when somebody says it to you. And you have to be involved, personally involved, somewhat educated, and vet the people who are handling your money if you're going to be successful. So I come back from the submarine. I get a month off after I give up command of the submarine to the next individual. and I start breathing and, and paying attention to the world. And I look at my accounts and realize our accounts that were at 1 million were less than 500,000 in
Oh,
2011,
ouch.
following the Great Recession. And
Ouch.
and there was this incredible polar opposite worlds that I'm now presented with, and I had trouble balancing that.
Okay.
And so on the submarine for 2.5 years, every time we got a little seawater leak, we had, an enemy ship show up or just didn't understand what was going on. People would bring the procedures. They're very well trained. And they would say, hey, the book says to do this, potentially this. My plan is to go do this one thing. And then an hour or two later, they come back and they give me updates. And I felt like I was informed, in control, and could somewhat have some influence on what the future looks like. And then
Mm-hmm.
on the other side, arguably far more important than my career surviving, maybe not more important than the 165 people on my submarine surviving, right? So safety was important. But big picture, it's pretty doggone important that you don't lose all your money. Yet I thought that I could just get no updates on that, right? And so the people who
Mm-hmm.
had my money didn't call, email, text, stop by, send a letter, nothing. And when I questioned it, I got answers that were not satisfying, like, you're in it for the long haul and we all lost money and it'll come back and your dollar cost averaging and all those kinds of things. And just none of those checked with my sense of sensibility. And at the time, I couldn't explain why, but I had this strong sense. I found Robert Kiyosaki during that period, and I went
Mm-hmm.
to a couple of seminars, and I just had this sense I needed to put my money into things that I could control, have my hands on. And so I
Mm-hmm.
pulled all the money out of the markets and put it into real estate over the next year or two.
Oh, wow.
Yeah.
So even though it was in like 401k type plan, am I right? The 500,000, or was it
So
outside of that?
less than maybe a third of it was in the 401k world. And so I
Okay.
did get that moved over to self-directed.
Okay.
And I did essentially the same stuff. But actually, a large portion of my money was not in the 401k because at
Okay.
the time, we just couldn't contribute as much to that environment. So
Yeah.
my wife Sue and I were contributing more than 50% of what we made from day one. And we did it for 20 plus years. So there was a large brokerage account.
Okay. So there was
Yeah.
a certain amount of control you had over that portfolio, or that
Yeah.
portion of your portfolio that wasn't government controlled, but you still had about a third of it that was in the government plans, which
Yeah.
then, and guys, I don't know if you've heard of this, but the idea of self-directing, most of us get sucked in if we have 401k or IRAs where you can only invest in the stock market, mutual funds, and things like that. But there is a way that you can, once you're in control of your own plan, like if you leave employment, you can transfer it to an IRA, at which point you can do some self-directed investments. Multifamily real estate is a common one that comes up. Oil and gas investments might be one of those, and a number of other what are called alternative investments suddenly become available under certain guidelines that you may not have been aware of. And so that's what Gary's referring to when he says self-directed.
Yeah, and you can get even more advanced than that. This morning, I was attending a course with our family bank members program that we're involved with, and they're talking about a program called Rollover for Business Startup, where you create your own 401k, start up your own business, and you can do this with retirement funds. Now, there are people out there listening who will say, "Oh, that's a prohibited transaction," and with the very basic tools like an IRA, it is prohibited,
Mm-hmm.
but it's not across the board if you get advanced. So there's crazy stuff you can do with that if you take the time to
Yeah.
educate
So
yourself.
yeah,
Yeah.
let's talk. Actually, we've got a joint client we just met with for an annual review. What was it, Monday? And this guy,
Hmm.
a W-2 earner, in a very high
Hmm.
earning period of his time, $200,000-$300,000 a year coming in, had built up a bunch of money in his 401k, and then started to understand this and realized, wow, this might be a path out of my W-2 job into a business venture. And so he's done this with some support from tax strategists to give him the I's
Hmm.
that need to be dotted and T's that need to be crossed, but rolling out his 401k funds into something that he can have control over, which is his own business, which most people are totally unaware that that's possible. And that's not the purpose of today, but you guys just need to know there's a lot of interesting opportunities if you feel stuck in government qualified plans and are looking for alternative things and you don't want to incur a huge penalty tax by taking it all out at once. There are some interesting ways that you can find uses for your own benefit, and this rollover for business structure, or ROBS structure, might be worth taking a closer look
Yeah.
at. So
So
Part of
there,
hold on, I just had this thought I needed to share. So part of what you're talking about is the need for a certain level of control over our
hmm
money, right? A certain amount of
hmm
knowledge, being aware of what you have and why, and how that's going to help you moving forward, what the pros and cons, the risks and reward, and the nuances of how these things work, so that you really have a sense of influence over what happens and not just being subject to the whims of the market,
yeah,
right?
I wouldn't say that that's part of it. I would say that's the core takeaway
Okay.
lesson learned from all of my experiences. And that goes back to those pillars of your life. If you do not have involvement and some level of control, you're just gambling. You're gambling with whether you
Mm-hmm.
stay alive a long
Mm-hmm.
time, with your health. You're gambling with your relationship, whether your spouse stays with you. You're gambling whether your kids are going to hang out with you. Like if you do not have some level of control and involvement, the more the better. Then that portion of your life is going to fall apart.
Yeah, it makes so much sense. I
There's
often
if you
use,
remember the old uh, gosh, I don't know if it was Office Depot or Office Max or who it was, Staples, where they had the easy button, right? Like so many
yes,
people want to push the easy button, and
uh-huh,
people who are selling you the product will tell you you can push the easy button, and you can. What they don't tell you is that the thing's going to blow up in the background at some point. I've met people who
yeah,
have been lucky for 3 or 4 years, but then it blows
yeah,
up and they don't know why, and they can't predict that it's going to. Thankfully in my life, I'm so grateful that my stuff typically blows up right away. And so I don't get this lulled into, man, you're a genius, you're just doing so well. That doesn't typically happen for me. I get to learn the lesson and move on. And so I know that you've
yeah,
talked with your audience, just kind of talking about that control side. You've talked to your listeners a lot about the hierarchy of wealth, or we've covered it at least, right? And
yeah,
that was the thing that when Patrick Donahoe started talking to me about that as a client in 2011, really, really resonated. And I've been forever grateful. I talk about it more than he does because it just has so much. I talk about it with every client. When a
yeah,
client calls me, my 1,000 clients, 1,000 families that I have now, and they call me and they say, should I use a policy loan for X? Wade, you do the same thing. But the first question is, hey, here's what I have for your financial situation. Do you think this is accurate? Like, would you say this is accurate? I'm like, no, I need to update some stuff. Okay, I can't answer your question then. Well, let's update it. And then once they've updated it, we represent their situation on this hierarchy of wealth. And
yeah,
simply all it is imagining you're building your financial life for the family, maybe even for generations. And you put the bricks in the bottom layer first, like the Egyptians would if they were building a big pyramid. And then you move to the next layers when you've got that solidly filled out and you didn't skip any bricks down there. And so you're just kind of building from the bottom up. And the bottom is where things are lowest risk, highest control, maximum certainty. And then you
mm-hmm.
just go up from there into the investing world. So it's savings first, and then you get into the investing world. And those are things you directly control and are involved with, like your own career. I did a great job there, my own primary residence.
Yeah,
But then then you move up from there into things that you're kind of passive with, and then things you're just speculating. And so as a purist, I always tell people, like, if you don't know specifically the name of the person and their experience level who has your money and everybody between you and your money, and you don't go to the board meetings and you don't walk around on the shop floor at Apple seeing what the new product lines look like, then you're speculating. I mean, you are
mm-hmm.
gambling. And so I was gambling. That's my whole point. So I was gambling for 20 plus years. And in the run of the 90s, it worked great. There's people
Yeah,
right now who are in their late 20s, early 30s. They've had the same experience. They can just throw a dart at the wall, buy that stock, and it goes up.
mm-hmm.
But it's not sustainable because you don't have that level of control.
Bingo, right? There's a whole conversation to be had about the sustainability and stability of your financial life.
Yeah.
I have a quick story. When I first started in life insurance in 2009, I had spent 4 years in banking. A friend of mine introduced me to life insurance, and I was really hesitant to get in because I knew it was going to be really difficult to have these conversations with people. And so when I finally decided it was the right thing for me to do, because it checked off most of the criteria of what I wanted in my ideal career path and the types of autonomy and compensation, et cetera, I said, well, I better check that out. I start seeking out mentors. And one of my mentors, a guy who'd been in business for 25, 30 years at that point in time, agreed to meet with me. And as I walked in, a guy that I had known at the bank I was working for walked out. And I just said hi and walked past, and went and talked to this mentor. And he said, and I said, I know that guy. How do you know him? That's been one of my clients for 25 plus years. We just had an annual review. I said, well, what did you guys talk about? He said, well, we reviewed his life insurance and reviewed some of his other investments he's had. And Wade, he commented to me that the only thing that has never gone down has been his life insurance. He's been a business owner. He's had real estate. He's had stock investments. But the only thing that's only ever gone up has been his life insurance. And I went, oh, like, that's cool. I can get behind an asset that never goes down in value and supports people's stability in their financial lives. And that kind of lit the fire under me in 2009 to start to go, oh, there's really something meaningful to the use of whole life insurance in somebody's financial plan. I didn't quite understand it fully at that point, but I started to see the light of where that could fit in. And then it was about 5 years later where it finally really clicked when I went to Truth Concepts. Guys, there's this training by a guy named Todd Langford that helps us as financial advisors use financial calculators to tell the whole truth about how financial assets work. We look at the tax, we look at the investment costs, we look at the different variables of inflation, we can look at all kinds of things to help tell the whole truth mathematically about money. And we looked at market rates, like what you're just talking about, versus the stability of whole life and the average over the history of the stock market. When we look at the actual ups and downs was like 5.5 to 6%. And I went, wait a second, it's not 8, it's not 12. No, the average was 8 to 12, depending on your timing in the market. But the actual was lower because when you actually put $1 in and experience the ups and downs, it creates this lower number, guys. And I went, wait. I've been told basically a lie my whole life up to this point. And now I finally see a 5 to 6% return in the market, which is still taxable, versus a 5% return in life insurance, which is tax-free. Why would I put my money at risk in the stock market? And it just like, bingo, lights went off. And I started to truly see the value of this type of use of whole life for what we now call the family bank strategy.